Welcome, everyone, back to episode 22 of Junior Resource Investing. I'm your host, Matthew. Disclaimer here before I get into it. As always, this is not financial advice. Neither myself nor my guests are financial advisors. We're not your financial advisor. This podcast is for entertainment purposes only. For full disclosure, please check the YouTube notes below. Regardless, though, I am pleased to welcome our latest guest, Brendan Yerk, onto the show. Brendan is the president and CEO of Electric Royalties. Electric Royalties is a royalty company established to take advantage of the demand for a wide range of commodities that will benefit from the drive toward green energy and electrification. They have a growing portfolio of 21 royalties, including 2 royalties that currently generate revenue. The company is focused predominantly on acquiring royalties on advanced stage and operating projects to build a diversified portfolio located in jurisdictions with low geopolitical risk. It trades under the ticker ELEC on the Venture Exchange and ELECF on the OTC in the States. Brendan, thank you for coming on the show. How are you today?
I'm doing great, Matthew. Thanks for having me on.
Yeah, perfect. So this is going to be a little bit different than my typical setup. Obviously, you can probably imagine that usually I get explorers and developers kind of coming through here. As a royalty company, it's going to be a bit of a different conversation. But maybe we'll start out the same way as always. Though, why don't you just, I'll give you the moment here, just pitch Electric to my audience, and then maybe focus on why investing in a royalty company has benefits versus traditional explorers and developers.
Yeah, for sure. That's definitely a big part of what we wanted to do when we decided to found this company. Royalty company. So we're Electric Royalties. Like Matthew said, we've got 21 royalties. 2 are currently producing. We actually are expecting a 3rd royalty to enter production here very short term. It'll be the largest lithium mine in Canada next year. So that'll be very exciting. That's a big one for us. But royalties are really, diversification. You spread out. We already have 21 assets. Mining is a risky game. You never know with 100% certainty if any mining asset's going to work out. So diversification is very key. So we're already diversified across 21 different assets. The other nice thing is, these are rights to cash flow, right? So, right away we have no costs. There's no development costs, capital costs, cost overruns, anything like that. Very highly capital intensive process if you're a developer going through that. So we're not diluting during that process. Essentially when they are in production, we just get a percentage of cash flow, and it usually comes straight off the top line. Which means our unit operating costs are 0, right? So, if copper's $3.50, it means we're going to make a little bit more than if it's at $3. But we're not necessarily, going to be in trouble in terms of our G&A because that's very flat and low. Our G&A, speaking of G&A, if you were to build a very small mine, I worked at a very small gold mine in Arizona, very small, 50,000 ounce heap leach. They had to hire about 75 full-time people to build out that mine. So then you're taking on a massive amount of G&A, and I can't remember exactly what the number is, but ours is about $1.5 million a year, and we could get that down, even further if we wanted. I'd say about 1/3 of that is marketing, and 1/3 of that is actually active deal costs of continually doing deals. Royalty companies, so typically trade at better multiples because of that lower risk profile, because you have diversification. And like I said, we're not being diluted as companies are moving these projects ahead. We've had over 400 million, close to 500 million come in and be put into the ground on our projects, really going into our projects over the last 2 years. And so that's all, money that we didn't have to raise. We didn't have to put that in. It would have been about, 500+% dilution if we had to. And so we also have no holding costs, right? So that costs us really nothing. After we acquire that royalty, it's there. It's an asset on our books. Most of the royalties that we have actually stick to the land as well. So, even if the operator was to go bankrupt or, loses the project for whatever reason, because we're targeting good jurisdictions, they've got pretty good mining codes. And so we can actually tie that to the project, rather than to the company. So it's really a much safer, longer term way. Royalties pay out typically over the long term. Some of our royalties in our portfolio, Battery Hill is a great example. It's got a 40+ year mine life. We're expecting that's going to pay us anywhere from US $3.5 to $5 million a year. And so that's a lot of cash flow over time. And, continually as you have more royalties coming into production, all at no cost to you once you've acquired them, you can get up to a significant amount of cash flow and your G&A stays very low. So it's a much safer way. The way I put it is we're one way for investors to get exposure and play the entire clean energy metal space. And I think that's really good for investors who don't really know how to tell a good lithium project, or don't even know which clean energy metals they should really get into, which ones have been overbought, oversold, etc. But also, especially when you're picking a company, picking a developer or an explorer, they're typically one asset companies. And so, it's a lot different risk profile from what we're doing. But part of that is, look, I'm all in. I'm invested about 95%. And my family's a very big investor in the company. And so, we wanted to make sure that we, as much as possible, could conserve and build that wealth in a stable way.
Yeah, and that last part you make is valid, right? That it's always nice to see when insiders and family have money, and obviously that means that you're kind of tied to the hip of investors as well. So that's always nice to see. What the things you're saying, it touches on everything that I understand too, right? I mean, that you still capture upside, but without all the trials and tribulations and ridiculous risk that comes with living and dying by assays, as discovery plays do, right? That you cut all that out, but you still have access to the upside. I think it was Rick Rule who said that if you can take away half of my upside, and if you get rid of all of my downside, I'll take that trade every single time. And that's always what's kind of comes to mind with royalty plays for me, right? So,
well, we still get the same pricing upside, right? If prices go up, our revenues are directly proportional to that. So, lithium prices have gone up, I think, about 10 times since we bought our first one, and so our expected revenues go up about 10 times. So, we still get the pricing upside. We still have exploration upside, right? If they're successful at the project, that's going to mean we're getting paid for even more years to come. But yeah, definitely a reduced risk profile, different type of investment than your typical kind of mining investment.
Mm-hmm. Yeah, different skill sets and knowledges, which we'll touch on here. And maybe that's a decent transition. These are going to be fairly simple acronyms. I'm going to assume that, a lot of people listening here, NSRs and GSRs and GRRs. But maybe, do you just mind, just for the sake of this conversation, I'll bring up an image or a visual to help with people this too. Can you just dissect the difference between those three? Because if someone goes onto your slide deck, they'll be seeing that that's how your valuation is, that's the fundamentals of your valuation. And then maybe, break us down GRR, GSR, NSR. And then maybe from your perspective, what's your preferred route, if that's all right?
Yeah, sure. So GRR is gross revenue royalty. That means, whatever their revenues are straight off the top, so the top line number, it's a percentage based off that. So if we have 1% and they have 300 million revenues, it's 1% times 300 million. That's how much they owe us. An NSR, which would probably be the second most common one out there. That's something that I think is actually going to be changing a little bit when you talk about the clean energy metal space. It's a little bit archaic, because sometimes these mines are producing products, they're not sending it to a smelter, and that's really what that was for. Mm-hmm. Smelters, when you send it to them, you got to pay for the transportation costs to get there. They usually ding you a little bit in terms of what the payability is for each of the metals, and there's a treatment charge. So net smelter revenue royalty would basically be your top line revenue, you deduct the transportation, the treatment charges, whatever the smelter dings you, and then it's off of that revenue line. All the other ones are pretty much, some kind of iteration of that. Gross metal royalty is basically gross revenue royalty. GSR, I don't know exactly what that could be gross sales royalty, which would be the exact same thing. But typically there's, for a net smelter, there'd be some deductions because you're sending that product to go get, smelted at a third party. But we always do gross revenue royalties pretty much. All the new royalties we've created have been gross revenue royalties. If you look at our portfolio, the vast majority of them are gross revenue royalties. I love that because it just makes it way easier, to forecast. There's less chance for groups to kind of haggle with you over how much they owe. It's pretty obvious, at that point, right? And it's much cleaner. So we typically like to do gross revenue royalties. And because we're, going out there, we're one of the few groups actually on the royalty side and the junior side, goes out, creates actually new royalties, where we're going directly to companies, negotiating with them, offering them money at a certain point in time. And so we have a little bit of power to say, hey, we want to make this a gross revenue royalty. Typically the difference between the revenues would be about 10-15% between a GRR and an NSR. The one that you really want to watch out for is net profit interest. If you ever see that, it's not a royalty. If they're not profitable, you're not getting paid. So net profit interest, that's the one you do want to watch out for because they can be a little bit hairy.
Yeah, thank you for that. And this is actually a decent transition. You talk about how you actually go out and acquire these royalties. Do you mind? I want to talk through your selection process a bit here. Maybe why don't we just start there, right? I mean, can you just discuss? Do you seek out projects? I mean, is there some sort of like a Tinder for projects that are seeking royalty companies themselves, right? I mean, and then maybe from there, just discuss like how much wiggle room is there in negotiations, if you don't mind. But yeah, let's.
Yeah, sure. So I'll start with the first one. I mean, typically we pick the project. That's the way I like to do it. We know the projects that are out there. That's what we kind of first did when we started out a couple years ago. Is you look at the average development timeline in mining, and it's 15 plus years typically. They might get it done in 7 or 8 in lithium. That's what they're thinking. We'll see how that kind of works out. But it's a long time frame, right? And so really from our perspective, we're looking for those projects we think can actually make it into production and be that next wave of supply that you'll need, over the next kind of 3 to 10 years. And so when you look at that, the pipeline of projects is very thin, funnily so, like where you can go down certain commodities. We target all 9 clean energy metals. If you look at some of them, like manganese, we have really the best and only district in North America being developed. We have our producing royalty, our lithium royalty. That's going to be on the only producing lithium mine in Canada. So there's not a lot of these advanced projects or projects, near production. So we're picking off the best ones, the most advanced ones. And some of these might be, 4 or 5 years out from production, but we know there's nothing sooner than that, So it gives us a little bit more certainty and really knowing that we're going to need these metals. I think when you look at this space, it's different than the gold space. I think the growth profile here over the next, 10, 20 years is going to be incredible. This is a sector that basically didn't exist, 10 years ago. And 20 years from now will be, as large as oil and gas, right? Which is kind of crazy to think about, but that's an incredible growth profile. And so your second question, no wiggle room in negotiations. Everyone is different. Typically I'm the guy that has no wiggle room. I say, this is what I can give you. And I hope that works. Because I think you could use it, I think that's a helpful amount. But typically it's this is how much I got to get something done. So are we going to do it or not?
Yeah, fair enough. Okay, good. So maybe that's another decent transition then. So, I mean, you kind of referenced it, you are yourself a smaller royalty company. You're not Wheaton Precious Metals by any stretch, right? And nor do you need to be successful, obviously. And you're also targeting smaller companies themselves, right? So I guess, I'm going to guess that you can't just have your pick of the litter in terms of you can't walk out there and you're not going to get a royalty on Great Bear or something, right? But, I mean, do you mind just discussing, what's your selection criteria then, right? Size of project or grade? Obviously, jurisdiction's a big one for you. How much does management factor in?
Yeah, well, certain projects management definitely factors in quite a bit. I would say if they're planning to produce as that team, that's probably the number one most important thing would be the management team and the operations team that can actually make mine work. And that was the case at our most recent deal we closed. Penouta, fantastic operations team. They've done it before, so that it is very important. Typically, like I said, we focus on the projects. There are certain projects we'd like to get in. It just isn't feasible. I think, primarily we try and be value accretive, right? So we're looking for ways we can get in and buy a good royalty on a great project, but buy cheaply, as it were. That is really kind of staying outside of a couple areas. One would be, 12 months of production on a big deal, right? So if they're that advanced and it is a big project, you have all the big private equity groups playing. And, those guys can write a $25 million check. We haven't even invested $25 million for all of our royalties, right? So, we're not going to do that all in one royalty that kill the whole diversification. But they can do that. So you can't compete with them in that space if they have a feasibility, 12 months production, big project. And producing stuff outside of small producers, we can participate in small producers where we'll do a check size under 5 million. And private equity groups, the big guys, they won't do that. So that's kind of an underutilized niche. And then on the development side, really anything 12 months outside of production, there's almost no alternative financing available. And so that's kind of another area that we play. I like to get in 12 to 3 years out is really the best, where they have economics out already. You can pretty much tell what the project's going to look like. And a lot of the time, really it's infill drilling, which is really tough capital to raise. So companies get stuck there. But you can look at the drilling yourself and kind of make a determination. It's really about getting it up to the standard you need, right, for an NI 43-101. And sometimes that can be 10, 15 million bucks. it's really hard money to raise. And so companies get stuck in that kind of area, and you can kind of go in, provide some capital, help give them a boost. But really, yeah, in that area, I mean, and you don't have much competition there. We're getting it much, much cheaper. And, over the course of 12 months, 2 years, the value of that royalty can just skyrocket in value.
It's funny. That's one of my favorite moments to invest in a company as well, is that orphan period, right? Where the resource is known and all the exploration risk is gone, right? That's off the table. Now it's just a matter of actually transitioning into a producing mine, which again, it becomes a much more predictable, well, there are different sets of challenges obviously than pure exploration, but more predictable than in a pre-discovery drill. Yeah. Living and praying with the drills, right? So fair enough.
More data, better. Yeah.
Yeah, exactly. Well, exactly. Right. Exactly. As an investor, you want knowledge and data, right? So, gonna keep grinding on this selection criteria just because I find this really curious. I guess maybe I'll ask you about, are you sector agnostic, right? I mean, on a right deal, would you pursue, like, I don't know, precious metals or potash or something for the right project? Or are you pretty fully thematic with battery metals and electrification?
Yeah, we're fully thematic right now, and part of that's just really, it's 9 different metals. Most of the royalty groups target 1 or 2. Silver, gold, really. Yeah, I mean, they all do copper, and they'll kind of cheat on nickel a bit as well. I think we're sector, like, we're stuck, on this sector. I think there's so much opportunity here. There's a couple more metals we could add, quite frankly, outside of our 9 that we already do. So we'd probably look to add those before we'd, do anything else. And I see so much opportunity here that I think we got enough to keep ourselves busy for now.
And I mean, you're absolutely right. I mean, the forward-looking, the compound annual growth rate for this sector for 0, 5, 10 years is ridiculous. So I mean, you're absolutely in the right corner of the market, right? Maybe one more here, then we can move on. It's just, so you have 21 or so projects. I think the plurality of them are lithium. But do you have is there a specific ratio between these metals that you have? And I think I asked you this question when we chatted with Six a couple weeks back. But is there a specific ratio you're going for between these different metals and minerals, or are you just picking the best product available you can get your hands on?
Yeah, so I'd say it's a bit of a combination of the two. I mean, if you look at our portfolio now, we've almost got 2 assets for each of our 9 commodities. And so we have been, quietly kind of filling that out to make sure that we are still diversified. We have exposure to all of them. We're a bit heavy lithium. That was really just opportunistic. We had a couple of good deals come our way. And this is pre-lithium prices, jumping off and as it was happening. And so it was like, oh, God, we got to do this. We can't pass this up. So sometimes it's just opportunistically, we see a deal or opportunity and we just say, hey, yeah, we definitely want this. But traditionally it's us kind of going out there and picking up the projects and trying to do it in an order where we do stay diversified. I think we do make a little bit of a bets in terms of, I really like tin. I really like copper. I like nickel as well. Lithium, obviously, we've done quite well in. So there's some metals that would be a little bit higher on. And then less so in others, but generally we do want to be diversified across all clean energy metals. That way we're not really making a bet in terms of where battery chemistries go, which technologies may come, and I think all the commodities you have risk. Even lithium, I'd say lithium's biggest risk is future supply, but that's probably a couple years away still. I know everybody talks about it coming on right away. It's very hard to put a mine into production. Always overestimated, so we'll see how that goes. But that's generally how we plan to take it.
No, good enough. So I'm going to ask you now, we kind of talked about the benefits of royalty cos versus explore cos, and I think there's just an objective value for a royalty company that explore cos just don't necessarily have that. But maybe on the flip side of that, what are some added layers of complexity? For me, as someone, I like explore cos and I like discovery plays and development plays because I enjoy the geology of it and, calculating dollars per ton and stuff. It's obviously a different game. It is and it isn't, but it's a different game for royalty cos. What are some complexities or valuation complexities that investors should be aware of when researching royalty cos to invest in?
Yeah, well, the biggest one, and it's the biggest hurdle to getting analyst coverage, quite frankly, is that we have 21 assets, right? So, traditionally, a mining company, do a developer junior, was going to have 1 asset, so they can go look at a company. If they've got 1 asset, it's pretty easy to kind of wrap your head around. Whereas a royalty company, we've got 21 assets. So if you really want to get a full kind of grasp of, the value that we have in our portfolio, you'd have to go look at 21 different assets. And that's really, I think, probably the biggest hurdle for people to overcome. That's why analysts hate covering us. They can cover 20 companies, versus one royalty company, and that only gets tougher as we keep adding more. So, it's a lot to keep up with. We had like 70 updates last year, so there's a lot of news and progress being made all the time that you have to keep apprised of. But I don't look at that as a bad thing in any shape or form. I mean, if you got a company that's just churning out news for free all the time and good stuff keeps happening, I think that's great. but that is more difficult for people to assess the value. At the end of the day, it's really simple. If anyone ever wants to do it, it does take a little bit of time because you do have so many assets. But the revenue that we expect is really our gross revenue royalty rate. So if it's 1%, it's 1%. Times that by the expected annual production. So that'll be listed in any PEA, PFS, etc. And times that by the metal price. You pick it, whatever metal price you think or feel comfortable with. But that gives you the annual royalty revenue we expect from that royalty. You do that for each of our royalties. I think we have economics on quite a few of them now. And then you can kind of see, where you have $3.5 to $5 million a year from one for 40 years. And so the cash flows can really start to add up over time. And I think, over the next 5 years, each year we kind of have a couple projects that we think have a good shot to enter production on their own.
Yeah, and you're absolutely right. It becomes a free cash flow kind of story. I guess maybe as a follow-up question, I mean, is there a valuation that you kind of stick to as a benchmark? I mean, a valuation multiple, is it like free cash flow or price to earnings or NAV, or what's something that people maybe, if you in this sector, what do people look at?
Yeah, well, so I think there are two ways really for royalty companies to be valued. One would be based off of cash flow, and that's a little bit tougher for junior royalty companies, but typically trade around 10 times. Really, I think for junior royalty companies, PNAV would be the best example. Now that's really a lot tougher for some groups to figure out. I feel like I'm always a little bit hamstrung in terms of what I can say. I can't necessarily share what I have, our personal kind of calculations, but. When I look at it's typically you see about 1 times NAV. Now I say that's the average multiples. I have some Scotiabank, royalty report. They do all the companies, and that's the average. When I look at us, we're not trading anywhere close to that. So, it is what it is, right? But PNAV would be the way that I would say, is proper for royalty companies at this stage. But as we continue to grow 5 years from now, cash flow would be definitely a better one.
No, thank you. And I think that's this kind of conversation is important for people to recognize that obviously different sectors require different multiples and different metrics, right? So no, thank you for that.
Yeah,
so why don't
PNAV takes into account the time value of money, right? So it discounts, money next year is discounted at say 7%, money the year after 7, times 7%. So it is discounted over time. So if you have an asset with paying out 40 years. You get $3.5 million for 4 years from now. You're not getting value of $3.5 million in that net asset value. But it is, it's a great way to look at it, especially when you have a number of projects like we have that maybe are 3 or 4 years up from production, but they have 30, 40-year mine lives and significant cash flows coming back $200 million over time. So those should definitely be included in any valuation. Because if you're missing out, you'll just miss out. Quite frankly, the growth will happen. As you keep moving forward.
And that's where your growth can get exciting with that inflection point where once you start bringing these revenue streams online and providing you with free cash flow with which to grow your business, obviously that becomes a pretty exciting proposition, starting to target larger projects, right? And it gives you more muscle in the negotiation room, I guess. So, no, good conversation. Let's transition here. A bit more specifically about your projects, not just kind of a general overview of royalty cos. So, tier 1 jurisdictions, lots in Canada, you got, a handful in Australia and USA, one in Norway, I think, right? And then you have one in Madagascar, which maybe, obviously I know that Madagascar is resource rich in many ways, but maybe not what people consider tier 1. Do you just want to discuss what drew you there? What project is there and why it was so critical for you to tag in there?
Yeah, so again, there's a little bit of opportunistic. That was an all shares deal that we did with Fox Royalties. We like Graphmada because it has the potential to come back into production really quickly. And so we wanted to add another producing royalty. We already have a pretty good graphite portfolio, but it kind of helped us round that out. But it was opportunistic, because we had an opportunity to do that with Vox. And because it had that kind of prospect of near-term cash flow. Madagascar is kind of a special place, though, for graphite, I would say. Mick Davis has put a significant amount of money down there with his Vision Blue Fund. But, there's a couple places on the planet for each of these metals where you're going to have that kind of, The DRC for cobalt is kind of a special place. I'm not saying Madagascar is to that, for graphite, but Indonesia for nickel and Tasmania for tin, up in Cornwall, UK. So sometimes we're going to have to just kind of go where the projects are, where the metals are. It's a good place to be for graphite. That mine already operated for 30 months or 20 months continuously. They had all of their product qualified as off-takers, and that's a huge extra step that you have to take in the graphite space that you haven't seen before. We have such a long production run to go get your product qualified. So, they're ready. They could put that back in production. They need to kind of focus up and raise some money to do it. But, everything's ready to go there. And so it could be a quick turnaround, to cash flow, even as early as this year.
So I can't help but ask the question. So, I'm a tier 1 guy too for jurisdiction. I think that exploration and development is risky enough without adding in political chaos, right? But so maybe, are there no goal lines? DRC, right, for cobalt. Is that something that you, with the right team, would follow in there, or is that just something where you'll tip your hat and leave it for somebody else?
Yeah, we've had a few groups come to us. I would say they haven't been the right teams, not necessarily, but typically, when I started my career and I was in London, we had a lot of clients in Africa. Largely, I think, partially because of the time zone makes it easy, and we had clients whose camps got stormed by rebels and all that. So, traditionally, mining's risky enough. Why go there if that's going to happen on any given day? It just makes it almost impossible. That's part of it. The other part is I really do think there's going to be a need to have a domestic source supply for all of these metals. And when you look at that, like the tin asset that we bought, not our most recent one, but that's a great example. It's the largest and only tin producer in all of Europe, right? Crazy as that sounds. But we bought one in the United States, and the United States hasn't produced tin since 1980. This is the best, most advanced project in the U.S., but it's still 7 or 8 years from getting into production probably. So, I do think there's going to be a need to have that source of these metals at home for a couple of reasons. The security of supply, China, Russia, all that stuff, obviously very topical. People are already talking about that. The other part is, the whole point of this is to decarbonize the global economy. It doesn't make sense to be shipping, ore from halfway across the world to get to your plant that's being built in North America. Yeah. Because what are we doing then? So that's a very practical point, I think. And I do think that we're going to see that. I do think we're seeing that discussion start to take bolder form.
Mm-hmm. Yeah, and again, this is an area where you and I are kind of in lockstep. I think that this idea of the regionalization or the deglobalization of these things is underway, and maybe it might take a little bit longer than we anticipate, but I think that that's a sort of trend that is almost inescapable for the reasons you described, right? From geopolitical risk and also just from a pure kind of like tons of carbon produced for a project thing as well, right? So, no, you're situating yourself and positioning yourself in a pretty advantageous moment in time and sector. So,
we also have good mining codes too in those jurisdictions. So there's a lot of good framework to work in, and it means like I said, we can attach our royalty to the land. So there's a lot of benefits, but yeah, definitely, I think we're in agreement on that one.
Yeah, for sure. So I want to talk about your projects that are, producing revenue, but I'm going to just set those aside for a second and ask you just, opportunity to brag a bit. Do you just want to walk us through a couple of your flagship projects? Maybe take this the route that you want to. Maybe it's the one that's coming up to production next. Maybe it's just the one that you're the most excited about, most recent one, but you just want to kind of brag about a couple of your flagships?
Yeah, well, honestly, I love a lot of our royalties that we have. We individually went and picked those out. So almost every asset in our portfolio, I feel like I could talk about for quite a while. Look, we've had a lot of good news, right? So we've got 21. We talked about our 2 producing ones. I think our 3rd producing one, Oche, or 2 become producing. Oche would be a fantastic one. They are fully funded. The company, the operator, is about a $2 billion market cap. When we bought that royalty, they were about a $6 million market cap. So we bought that way ahead of everybody. Spodumene prices were about $400 a ton. Now they're over $5,000. But that's going to be the largest producing lithium mine in Canada this year. And they're targeting production this quarter. And so that's going to be significant. With lithium prices that high, that's going to be very good for us. So we're very excited about that one. We also have Seymour Lake. It's another lithium royalty in Ontario. Now, we bought that around the same time as we bought Oche a little bit a year later. And they've just raised $70 million. They've been moving that so fast. They doubled the resource. They've brought in Lithium Americas to fast track Seymour Lake to production. They're getting ready to do a bulk sample, and if they have that expedited timeline, I mean, you could see that make it to production, much quicker than traditionally. And the royalty that we have on that one is 3 times as big as the one we have on Oche. So we're excited about Oche. Yeah. We're really excited about that one. That would be game changing. We did already talk about Battery Hill, so I won't bring that up. One of our ones that was a little bit actually farther down the depth chart. It was just recently had some great news. They've got a new partner. It's that Rana nickel mine, past producing nickel mine in Norway. New partner is coming in, committing $15 million to that project. It hasn't seen modern exploration since it shut down back in 2003. And they still had about a 10 million ton resource there. I'm really excited for this. I think that one could be another great candidate with a little bit of exploration success to come back in production. It's got a lot of the infrastructure, all year-round port access. And so we're excited about that one. Zonia, another great project. I picked that one out. Personally, I might get in trouble for saying this. I thought this is going to be one of the next 3 projects, copper projects to get developed in North America. It's not huge. It's going to produce about 50 million pounds a year. Our funding and the funding from our option funding will get them through the feasibility study within 2 years. But it's a simple project, copper oxide development project right at surface. It's got lots of drill holes, a pretty well-known resource, fairly simple too. And so we like that one. We're excited to see that move ahead. Man, we've got so many. I mean, it's tough. Mont, fantastic iron ore development project, partnered with Glencore. We have a royalty on the Vanadium byproduct credit. It's probably the best iron ore development project in North America. And I've worked on quite a few of them, so I have a sense of that. But that one's exciting. I mean, they had a 38-year mine life off their whole resource. The most recent PA just off measured and indicated was about 21 years. But a fantastic project. Glencore came in way earlier than I've seen them do on iron ore before. Anyway, there's a lot of them. We got a lot of good ones. I mean, do you want me to keep going?
Yeah. No, good on you. I like it. I appreciate the enthusiasm. I kind of realized when I asked you, tell me your flagship. Well, all 21 are going to be your flagship, right? So that's a fair point. Yeah. Maybe let's end with this then. Maybe what's the, based on current metals prices and not predicting higher or lower pricing, but just based on today's pricing, which one of these 21 has the opportunity to provide you with the biggest revenue? And what's that number right now off the top of your head?
I wish I could tell you that. Right now it would be lithium for sure. Yeah. As a commodity, lithium would be the top one. So we're heavily on lithium. And that's partially to do with the fact that lithium prices have gone up so much. When we bought those royalties, like I said, the lithium prices were less than a tenth of where they were today. So revenues that we expect now have gone up tenfold. That's made a huge impact, to our expected lithium revenues. But all the rest of them make up a pretty good mix. I'd say we're fairly well diversified in terms of our expected cash flows, and that's really the goal. So that we have upside to all these different price swings. I think a lot of these commodities are going to have the same price swing upside, throughout this cycle that lithium's gone through. Not that lithium's done, and not that it won't go down and come back again, but I think a lot of these metals have the same upside potential. Copper, I think, is a really easy one to see a more modest kind of increase in price over the next couple of years. But we need a lot more copper. Tin is my favorite, though. In terms of the supply-demand fundamentals, I just don't know. I don't know how we're going to find enough tin, but it's gonna be good. The world, I don't know. There's not that many people out there paying attention to this on the supply side. Everything seems to come down from the demand-driven side, where we need this. We're going to build the factories, and they're already building the factories, right? Factories take 2-3 years to build. The mine's going to take 7 or 8 to maybe 10. So, it's really kind of, I don't know, poor planning in terms of timing-wise. But if you're invested in these metals and your revenues are proportional to metal prices, I think metal prices are going to be very, very strong across the board as we move forward here.
And again, I kind of, as I was doing my research for this interview and seeing, again, like you say, the commodities that you mentioned, tin, zinc, graphite, these are all things that I've circled myself, kind of put it up on the board as saying that these are going to be chronically underdeveloped, underfunded in terms of exploration, and there's going to be a supply crunch, right? And and that's just, it's you can't turn the Titanic in a day, right? This is going to take years and years of redevelopment to get these things back up in the air, right? So, no, again, I think it's prudent on your part in terms of where you've gone with your money. So,
well, again, because I'm all in and my family's all in. We're very careful about spend our capital, and we're excited. I mean, we have lots of catalysts that are going to come this year at no cost to us. That's all already baked into our portfolio, and I'd say that we have one of the largest deal pipelines out there as well. And so we're not going to be just sitting here on our hands. I definitely think we'll be adding some more royalties. Maybe even before you get this out now, who knows? But we've already got 21 royalties. We've only been at it for a couple of years, so we'll definitely keep adding some more as we move along.
No, exciting. So let's talk about, here's an analogy for you, right? That you have just nicely transitioned into a revenue model. So you're the first couple of years of mine life where you're not running at peak capacity yet, but you've got some revenue. It's kind of nice to see proof of concept going here. So you do have two, if I'm not mistaken, and you said a third kind of in the works, or 3 or 4 that are right off the bat coming up right nearby. But you've got the Middle Tennessee zinc mine and the Penouta tin tantalum mine, which you mentioned this is in Spain. Do you want to run through those projects maybe a little bit? And then, if you can, I think my understanding is Middle Tennessee is private, so maybe you can't give us as much details on that. But maybe explain to us what we might anticipate from those two deals as well. Pardon me.
Yeah. So the Middle Tennessee zinc mine, we can start with that one. It is private, but it's privately owned by Graphmada, which is a massive group. I think they had over 200 billion in revenues. It could be much higher than that last year. So they're very well funded. They took over from Nearstar. Ultimately, they kind of took over Nearstar, and they acquired that. But they came in a couple years ago, so we're excited because they actually have some money to spend. Traditionally they've gone in and upgraded and looked to boost capacity at their mines. So, they don't share everything with us, but that's what we're expecting, and that's kind of what we've heard and seen so far. Really, we just expect that to keep producing. It's been producing for intermittently over 50 years. Already spit out about 2 billion pounds of zinc, and the concentrate there is actually really, really clean. So it's really integral to the Clarksville smelter, which is right next door. And that smelter is the only primary zinc producer in the entire United States, which sounds crazy. But the concentrate from the Middle Tennessee zinc mine really helps them take a lot of other ores and blend them because it's so clean. So it's kind of got some other things going for it as well. But really, we just kind of expect that to keep chugging along and making money. I think zinc prices are going to go up. The zinc supply side is also very weak. There's a handful of development projects out there globally that I would like to get involved with. And so, I think that one we just expect to keep kind of paying out. We have an option to double our royalty interest. That comes up in August of this year. And so, we'll see how that comes along. But, really exciting royalty, great operator, great jurisdiction, long operating history, and we expect producing for a long time to come. Penouta. The largest and only tin and tantalum producer in all of Europe. Which is crazy because you think about all the money that's been going around this space, and to think that we're coming to the table with $1 million, so the only guys actually producing this stuff in Europe, just is funny to me a little bit. But fantastic operating team, like I mentioned. This has been mined. This area has been mined since the Roman times, and it's pretty easy. It's an industrial mining project, a little bit different. There's multiple revenue streams. So they have tin, they have tantalum. The money that we just gave them is going to help them look at exporting high-grade feldspar, actually importing within the country. And they also have some rare earth potential there as well. Everything they dig is basically ore, which is pretty cool. That was the overriding thing that we sent our guy over. We like that. Look, they're producing at a pretty good rate right now. They keep steadily ramping up production, but they have an opportunity to double that plant capacity. And it would cost them about $10-12 million. And I expect they'd come to that, in the next kind of 12 to 24 months. So, we bought that royalty, we paid $1 million. Tin prices are down already 50% from their peak last year. So we see, 50% upside, tin prices going up easy. We see, potentially 100% upside in our cash flows if they do pursue that plant expansion. So we see a catalyst coming that could meaningfully increase our cash flow. We actually also have an option on that project where we can basically double down on our royalty interest as well. And we have the next 6 months to decide on that too. So we have options to actually boost our revenues just off of producing royalties. And we expect some good news to come out specifically on the Penouta side for sure.
Exciting. So maybe I'll ask you this. So base case, right? Not expanded production, not expanding your actual royalty percentage, but just base case. Can you give us a number? And then, so I know that, tell me if I'm wrong, Tennessee's Inc., this was done last fall, and Penouta was done just in January, I think. But so I know that you don't have super firm long-term numbers, but can you give us an annualized revenue rate on those?
Yeah, and the numbers on our Middle Tennessee royalty can be a bit fuzzy because we have that via JV partnership with Sprott. As part of the acquiring that brought in, they put up the $13.5 million cash that we needed, and so we're actually a JV ownership. So sometimes the funds in terms of when they get reported and stuff, but it's about $500,000 a year is what we're expecting from the MTM royalty. So we're to double down on that. That'd be $1 million a year, and for the Penouta one, just kind of base case off their revenues really over the last 12 months. We're looking at kind of $150,000 to $200,000 a year. And that's, before they add in some of these other revenue streams, before they, if they look at plant expansion, and not taking into account metal prices. So, I think all the upside's still on the table there.
Mm-hmm. Mm-hmm. Yeah, absolutely. It is. Yeah. You're year one of your mine production here, right? So yeah, you're just getting,
and they got a mining license for the next 30 years, renewable up to 75. So, that's the thing, right? You buy these royalties, it might have a 10-year mine life, and it'll still be paying you potentially 20, 30 years down the road.
Yeah. Not a bad gig, eh? Not a bad gig at all. So why don't? This is kind of a curious question. So once you've made the deal, are you involved at all in the operations of any of these companies, or is it pretty hands off after the deal is made?
Yeah, the nice thing is that we don't have to be hands on, right? So there's probably 500 people employed working on our projects. Many management teams, a lot of managerial hours going into that. So we don't have to get involved with that. We typically don't like to get involved with the day-to-day. But we are partners, right? At the end of the day, I look at all the deals we've done as partnerships. I think, at the end of the day, we're only going to make money if they get into production. So we're very incentivized to help them, along that path. So, I think we make introductions. We offer advice. We happy to, offer some suggestions for M&A activity as well. And so, yeah, we try and, help out where we can. But mostly with advice on financing or things of that nature. Maybe there's things that we've seen because we've looked at other companies in their space. So we just try and help out as much as we can. But in terms of the day-to-day or the actual having to do that stuff, thankfully that's not our job.
Mm-hmm, mm-hmm. And then one final question here, then maybe I'll just transition and do some more traditional questions just around your company and your personal history and such. But so yeah, you're just nicely getting started on the revenue side of things, which again is nice because it starts to give people these hard numbers and we can start looking at forecasting and such, right? But so how long, in your eyes, let's say not best case or worst case, P50, right? How long till electric starts to kind of hit its stride in terms of revenue? How many years out are you guys?
Yeah, I'd say, in that 3 to 5 year range, that would be like, if we could wait and just sit here for 3 to 5 years, that could maybe be the best thing that ever happened. I don't think we'll make it that long. I think someone will try and, buy us out opportunistically, especially, these valuations. But, 3 to 5 years, because 5 years is kind of the range where a lot of our big development projects will start making it in. And so then you're talking about a huge jump up, in terms of cash flows. But really, over the next couple of years, we've got a couple more that can enter production. I think we're going to be very busy, continuing adding new producing royalties, trying to, supplement that part. But 3 to 5 years, I think, is the window. I think that's where metal prices are going to be, very, very good. I think our number of royalties in production, we have like 8 or 9 of them that could make it in that time frame. And so, it's going to be exciting. But that's, again, we don't have to do anything for that to all come true, right? So that's all. We've already put the work in. We've already bought those royalties. They're going to do that for us, on their own, and it's up to us to keep kind of adding to it.
Yeah, and that's exactly, this is a point you've made, and a point that maybe I'll make again is that, it's 30-year mine life here, right? That $1 million a year, but then you have 30 years of it, and then you've got 20 of those on the go, and you can start to see how things start to get very prosperous, shall we say, for electric in a hurry, right? So no, the royalty, it makes sense in a lot of ways, right? Let's just transition here then. There's just kind of a handful of questions here. I just thought I'd ask just about maybe the kind of current state of affairs of your company on a more kind of day-to-day level. But maybe let's just start with you, if you don't mind. Do you want to discuss your own personal career history and how you ended up here? What path ended up with you in the chair at Electric?
What path? Yeah, not a path I would have taken at the outset if I could have seen 10 years down the road. I joined the mining sector back in 2012. I joined Endeavour Financial in London. So they're probably one of the top project financing advisory groups out there. There's really not that many teams out there that do that. And they're basically the top ones. And I worked with them. And when I got there, they had about $8 billion in planned gold debt financings. I was like, wow, this is going to be good. Everyone's talking bonuses. 2 months into working there, gold goes from 2,000 to 39. And none of that made sense. I was like, oh man, this sucks. Like, and so it was really tough at the beginning. That was a tough year. That group actually split in half, after my first year. Came back, got a job in Vancouver with a group called King of Bay West. And they had a bunch of different groups, mining companies in-house, so copper, coal, stuff like that. And as soon as I got there, they had about 50 people. And they were really, like I said, heavy copper, coal, those kind of groups. Copper, coal, everything nosedived, So as soon as I got there, they went from about 45 people to 10 people over the course of my time there. And so I was kind of forced to be out on my own, a lot sooner than I would have liked. But a couple of weeks after that, I had, my own advisory group set up, and I had my first 2 clients. And it was funny, I was probably 26 years old, and I think the average age on my board that I was advising was about 82, So that's kind of, and that was like one of my very first couple of clients, right? So I just, I always made sure to find mentors and ended up working with most of the mining houses in Vancouver, worked with dozens of different clients on my own, just, really helping them out, mostly best efforts basis, at least when I got started. But really, this is like the exact same thing, except now I'm going to these groups and saying, hey, look, rather than pitch you on, I'm going to take you around and get you some royalty financing. I'm the guy, so in terms of actually putting deals together, it's great experience for that. But yeah, that's, I guess the last stop I had before this was really, while working at that small gold mine, as they put that into production. And just to see the number of risks and things that happened during that process, on what was supposed to be the most simple technical project of all time, going into that, I was just like, man, we got to do something different. I can't vouch to anybody, that this is going to work for sure, right? Because it's a single asset and so many things can go wrong, and even at the most de-risk stages. So it was really about like either I'm getting out of the mining sector, or we got to figure out something else, and something that I'd actually be comfortable pitching my family to invest in. And so that's when I decided to start Electric Royalties, and you have really 2 sides. One is the royalty side, that being a big part of the model, reduce risk, all the extra upsides of it. And then being the clean energy metal space, where you've got this incredible growth profile. I mean, I think the biggest average price increase in gold on an annual basis is like 25%. And we're blowing that away across the board, with lithium and, tin at one point last year. I think at one point last year, all of the metals that we target were up 90 to 100%.
Not bad. So again, fairly typical kind of boilerplate question here, but do you mind telling me insider ownership and then maybe, institutional high net worth? I mean, how does it break down, I guess?
So we've got very little institutional ownership right now because, quite frankly, it's very tough to get them in when you're a sub $50 million company. I mean, those groups don't like to invest when they, it's, too small, it's a little bit illiquid, but really a $5 million check size where they can put $5 million in and knock over 9.9%. So we're working on it once we get over that. We do have a few institutional shareholders. I'd say they make up about 5 to 7.5%. Myself and my family, we're about 14%, give or take. And then we've got Stephen Gleason, who's a fantastic individual shareholder. He's really built up his whole position over the last kind of year and a half. And so he owns about 17.5%. And then we have Globex Mining Enterprises. They have about, they're our very first partner. We've done a couple deals with them, and they own about 13, 14% as well. And so you have a pretty big block of the company, tied up amongst a pretty tight group of people. From there, it's really high net worth individuals. I would say we've got a lot of those that make up kind of 15, 20%. And then retail from there.
Good enough. So part of your deals that you make are, there is, I think that you can argue pretty convincing that it is accretive, but it remains dilution. For some of your deals, there's a share aspect to that, right? Could you, I guess, how is that standard for all your deals across the board? Is that something you bring with you because you are, a smaller project, and this is how you can kind of make these deals happen? And then I'll stop there. Is that a standard offer for you guys? Is share base?
Well, part of it is we've only raised like around $10 million to date, right? To fund all of this. If I could tell you what the MPV is in my mind and how much we've done, you'd be really surprised. But, so we've had to use it. I think there's a couple benefits to it. One is there's certain deals you won't be able to get done without it because, you're not able to really offer them what they want at that point in time. But if you're offering them continued upside and that same kind of participation in a portfolio of royalties, a lot of groups are buying into that. And so, quite frankly, it might be the only way for us to get a deal done is they want that ownership. And it also helps in terms of us getting a better deal, too, because, you can make the argument like, hey, our share should be valued at this. So it helps you kind of, build up a little bit of, find some middle ground, right, where it actually works for both parties. And, a lot of it has been just kind of opportunistic as well. Like, we haven't raised that much cash. We didn't have much cash. If we could get away with shares sometimes, we did, especially at the beginning. That came back and haunted us a little bit. I think that's partially why our valuation got kicked in the teeth so much this last year. But we are, by large, through all the shares that we had given out. We don't have any big blocks coming. And so that shouldn't be a problem. We're much more careful now, I'd say, about which groups exactly we do that with and kind of what their long-term plans are. But we also put in things to the deal where it's, we lock up a certain portion of their shares for 6 months, for 12 months, for 18 months. So we don't have a lot hitting us all at once anyway.
And then similar question here, just on the float side of things, and this is rough numbers, correct me if I'm way off, but it's about 90 million shares and about 20 million in warrants and options. Is that about roughly correct?
Yeah, that's about right.
And then could you just run through then, so that overhang, we don't need to beat it to death, but I mean, how much is left on the warrants? What are they priced at?
Yeah, so there's a good chunk of those that are priced actually at 60 cents. That was part of our MTM royalty acquisition. Those are owned by Globex. So those are, I'd say, not an overhang, at all. We do have some warrants from our last financing, the $3.5 million financing. So I think it was about 10 million out, and those are at, I think they're about 45 cents.
Okay. So yeah, not bad at all, yeah, in terms of potential kind of lids on the price if things start to fly, right? So, no, good. Then last one, I mean, you talked about G&As about $1.5 million a year, I think you said. Cash on hand?
Yeah, we're between $1 million and $1.5 million. We just closed that deal. We had about $1.5 million. It was a little bit more expensive deal because it's in Spain, legal due diligence, and all that. So we're probably down to about 1.2, in and around that range.
Okay. And then, so why don't we're nearing the end of it here. Just a couple of questions left. I mean, you kind of touched on Penouta being a potential exciting next short while here, but do you want to run through just 2023? What are some catalysts, 0, 6, 12, 18 months kind of thing? What does the market have to look forward to from Electric?
Oh, yeah, well, look, I think there's lots of stuff that's going to come out. We don't know necessarily everything ahead of time either, but like we just had $15 million committed to our Rana nickel project. That came out of nowhere. Really, I think the big one is going to be Oche coming in production. They are targeting this quarter, and that would be a big one for us. Our first listing cash flow. But there's going to be a lot of catalysts. We have our Battery Hills moving towards PFS. I think that's going to be a critical stage. Once they get to that, that's the time they can bring in a partner. Most of the partners want to see that kind of level. I think we've got Zonia. There should be some exciting news coming out as well, hopefully, as they move, towards feasibility study. Our Mont Sorcier project with Glencore, I believe they're targeting to get a feasibility study done, by this year or early next. So that'll be exciting to watch. Seymour Lake, I think, will be really exciting to watch. They're full bore ahead on that one. They've got the right partner, so it'll be very exciting to watch that. Like, they just doubled the resource, at the last couple of months. Now doing the bulk sample, lots of money going into it. Rana, like I said, that'll be interesting to watch. But lots of good stuff, honestly, across our entire portfolio. It's gonna be a fun year. We had, I think, over 80 updates last year, across 15 assets. So there's not many assets in our portfolio where these are just sitting there, exploration moose pasture or anything. These are projects, that we picked out we really like, and they're getting money.
You sound like you like your projects.
Yeah, I'm the one who picked them, so I did.
Yeah, no, good on you. So I guess last call then. I mean, is there something that I missed that you'd like to talk about? I just thought I'd give you a final word here to you, Brendan.
Well, look, I mean, if people are looking to invest, I mean, now would be the time. I think ultimately our valuation is grossly undervalued, and I wish I could tell you exactly how much, but it's not even a comparison. I think we're very safe, from a risk perspective. We're diversified across 21 assets and 9 clean energy metals. Those are in good jurisdictions and on metals with double-digit growth rates expected over the next couple decades. These are really the top-tier assets in North America, Europe, Australia for these metals. So if they're looking for a stable source of supply, they're going to be putting our projects into production. And that's all at no cost to us, and just kind of sit back and wait. We're a long-term hold. And eventually some group's going to come in and take us over, probably too soon, but shareholders get that bump then as well.
Just be patient, let your money grow away.
Yeah, exactly.
Well, that's it. Thank you, Brendan. Thank you for listening. If you want more information on Brendan's company, head over to electricroyalties.com. Lots of good information there. As for me, Junior Resource Investing on Spotify, YouTube, and elsewhere. Brendan, thank you for your time. I appreciate it.
Awesome. Thanks for having me on, Matt.
All right. Have a good day.